People do indeed want to learn more about their personal finances. They want to know how to handle their money better. But in the past, they've been very intimidated by it. Paying yourself first, maximizing contributions to things like 401ks and 403bs, being properly insured, that's well within all of our grasps. Budgeting, again, is a myth. It just doesn't work. It requires too much discipline. Most of us can't stick to a budget. It requires budgeting not only for needs, but also for wants.
Common sense financial planning from the most reliable friend you've got. The Wealthy Barber Returns with David Chilton. More ways that you can save money without getting clipped. Now please welcome author David Chilton.
Thank you. Welcome to the Wealthy Barber Returns, our sequel to the Wealthy Barber. It's fun to be back. It's exciting to be back this quickly. None of us could have foreseen the success of the first Wealthy Barber. We thought it would be a moderate success, that it would teach some people how better to handle their finances. But it took off, went national. We're already doing the second show. That's why we're here now. The two shows, by the way, are very much different. The first show concentrated on general concepts, dollar cost averaging, forced saving, the power of compounding, that type of thing. Today we're going to get a little more specific. We're going to talk a lot about retirement planning, how best to get at your retirement funds later on. And in segment number 3, we're going to look at a lot of fun things. Things that conventional wisdom tends to say one thing about, and Chilton wisdom tends to look at a little bit differently. And I think we'll have a lot of fun with segment number 3. Now, by the way, I did find that applause opening up in segment number 1 here a little bit more genuine than the first show. The first show was embarrassing. I walk out and the people are just, yes, Wealthy Barber. No one knew who I was. No, seriously, no one knew who I was because, of course, the show had never aired. We were just taping it, and the book hadn't been released yet. So I walk out and they're, Wealthy Barber, Wealthy Barber. The one guy looks at me, looks at his wife and goes, who is this guy? You know, and so he's going nuts, and he doesn't know who I am. I mean, they all thought it was a hair care infomercial. And half the people expected Cher to walk out on a stage at any point and start selling product, but it never happened. The other thing with the first show was I'd played touch football the previous Saturday, and I'd blown my knee out, and I had to get surgery and literally couldn't walk. I showed up here in crutches to do the show, and of course that was no good, so we had to throw those aside. But if you ever have a chance to watch the first show again, you'll notice the whole thing is taped from my waist up. It's like Elvis does financial planning. It was brutal. I couldn't walk around. I was limping everywhere and lifting my leg up, but we made it through, and as I mentioned, went on to become a big success. And I think that success proves that people want to learn this stuff. People do indeed want to learn more about their personal finances. They want to know how to handle their money better, but in the past they've been very intimidated by it. They thought you had to have good math skills, a very good accounting background. That's not the case. This stuff is not complicated. In fact, if you make it tricky, you'll do very poorly. All right, the bad things, the things that don't work, they really are complex. Options, limited partnerships, commodities, that stuff is challenging. But the good things, paying yourself first, maximizing contributions to things like 401ks and 403bs, being properly insured, that's well within all of our grasps. And that was the thrust of the show and also of the book, was to bring this stuff and make it fun. Now, why the barbershop set, in case you missed show number 1? Well, the Wealthy Barber book is a novel. And I think that's why it's done so well. It's a novel that teaches the basics of personal finance. It's set in a small town, uses a lot of humor, very different delivery style. Now, when I first wrote the book, I must admit, I never thought it was going to become a big hit. In fact, I thought it would sell about 5,000 copies. To show you how small we were thinking, when the book first came out, my grandmother phoned one night and bought 12 copies. My wife and I are running around high-fiving each other. Seriously, that was a huge deal at the Chilton household. We were like, yes, we packed up the books, shipped them off, and invoiced her in full. No discounts for grandmas. My father has told hundreds of people that I'm the first illiterate to ever write a bestseller. I don't know what illiterate means, but I don't like his tone. I am, by the way, a step ahead of my sister. She overheard that remark and she said, David, you're not illiterate. Mom and Dad are married and they had you. You guys get that one? If I go too fast, you guys let me know, all right? Now, I mentioned earlier, I want to focus a lot on retirement planning. There are a tremendous number of objectives within the financial planning framework. You want to plan for your children's education. You want to, of course, handle your credit wisely, save for a bigger home, and so on and so forth. But I think everyone would agree the most important objective is saving for retirement. In fact, if you combine that objective with the mandatory of being properly insured, you got to have the right life insurance, health insurance, disability insurance. If you just do those two things properly, you're in pretty good shape. You'll muddle through in the rest of the areas, okay? Now again, all of us recognize and agree that saving for retirement is the most important objective, yet very few people do it well. In fact, very few people do it at all. There are tremendous numbers of people, tens of millions of people, currently headed toward a retirement of very low income. All right, very low income. Now, why do people do that? Well, there are a number of excuses offered up. Probably the most common one is this. It's tough enough to make ends meet now, forget the future. You know what? That's a pretty legitimate excuse. It is tough to make ends meet now. It's always been tough to save. I mean, it involves making sacrifices. We tend not to do that well. We all have to save for our futures. That's where we're going to spend the rest of our lives. So what you try to do is the least painful saving. That's what we'll focus on throughout the course of the show. Now again, most people would agree with that, but they tend to still rationalize this excuse away with a second excuse. They say, okay, I recognize I have to save, but retirement's so far off, I'll worry about it later. I hear this all the time. People always are pushing it off. Well, procrastination was without a doubt the biggest enemy in financial planning. You've got to start now. By waiting, you're costing yourself tens of thousands of dollars. Time plus money plus compound interest can work wonders. We'll look at a few examples later. But time is the most important variable. You have to take advantage of it. And the only way to do that is to start right now. Let's look at an example here. Let's say you have one neighbor decided to set aside $4,000 per year at the end of each year, average a 9% return, pretty respectable, over a 5-year time frame. $23,940 approximately he'd accumulate. Not bad. The other neighbor, on the other hand, had started 15 years earlier. Same numbers, $4,000 per year at the end of the year, 9% rate of return, $204,000. Not 4 times as much, but almost 10 times as much money. That's, of course, because of the way compound interest works. All right, the important thing is to start right now. If you wait too long, you're going to be behind an 8 ball. It's going to be very difficult to get away from. It really is. Not only that, if this guy wanted to catch up, he'd have to save $34,000 a year over 5 years. Not going to happen. Okay, he's not going to do it. Even if he had the financial wherewithal, no one has that kind of discipline. All right, you've got to start now. There's another point that should be made, and it seldom is. It not only hurts you when you lose time from that perspective, mathematical perspective of time plus compound interest, but another angle comes to play. When you invest late in the game, you must take a more conservative approach. The better performing vehicles, things like stocks, for example, that have averaged over 10% over the last 40 and 50 years, involve some risk. There's no denying that. And the way to mitigate that risk is to focus long term. You've got to be thinking 7, 10, 12 years out. And if you are willing to do that, you'll be rewarded. But if you don't have those 7 to 10 to 12 years, the prudent approach, of course, is to go a more conservative way. Invest in things like CDs. The problem is that's also where the lower rates of return reside. So by passing on time, by waiting and waiting and waiting, 2 bad things have happened. You've lost the power of compounding, and you've also got to settle for lower rates of return. Tough pairing, okay? When I go out and speak to companies, when I teach to high schools, the thing I focus on most, start now. It may seem simple, it may be trite, but it's such an important concept. You got to get it rolling. Not tomorrow, not 5 years from now, but right now. The third excuse I hear a tremendous amount of is this one. I'll be dead before I get there. I get that all the time. I say, you got to save some money for retirement. Like I said, I'll be dead. Okay, my dad's a very intelligent guy, great athlete. I mean, he's a really good guy. He says to me a couple years ago, yeah, I'm getting close to retirement. I said, well, I hope you're doing the right thing. You know, saving a lot of money. You don't have to attack your principal too early on. He goes, oh, well, I said, I don't worry about that. He said, my dad died when he was 69. I said, well, that doesn't mean you're going to. He says, well, I mean, don't worry about it. I said, what are you going to do if you don't? He says, well, your mother here, we're going to move in with you. That got a little ugly between my parents and my wife. She killed them. She didn't actually kill them, but she roughed them up a bit. All right. The message got through. All right. You've got to start now. I mean, the odds are dramatic that you're going to be in retirement. Over 80% of the population reaches the age of 65. Over 80%. And if you're already 25, 35, 45, 55, whatever, the odds, of course, for you are even higher because you've made it past a certain number of years. For example, how many people here are over the age of 65? How many are dead? All right. Now, admittedly, that's not overly scientific, but 100% we're alive, and that's my point. All right. All right, on we go. Number 4, isn't that what Social Security is for? Fortunately, I don't hear this excuse as much as we once did. The answer to this, obviously, is no. Social Security, at best, I repeat, at best, is a safety net. It is not a lot of money. I mean, if you were to rely exclusively on Social Security, you'd live barely above the poverty line. This is not big dollars we're talking here. And yet, what's more, I mean, let's be honest, we can't count on Social Security being there in its current form 10, 20, 30 years down the road. We've had demographic shifts. We've got an aging population. You may have the tax changes come through to try to reduce the deficit. All this is going to negatively impact Social Security. You must do more. The responsibility is with us, the individual. We've got to take it. It's a good building block. I mean, it's a start, but that's all it is. You can't rely on it and it alone. Excuse number 5 is very similar. What about my company pension? There are very few well-designed defined benefit pension plans, and they are becoming fewer and fewer. Companies are passing over the burden of responsibility to saving for retirement to the employee and away from the employer. They're difficult to administer. They're very expensive to fund. It's a very competitive arena out there right now. The world economy, of course, you've got to pass off some of those responsibilities, and that's what you're seeing. We must take the responsibility. Now, if you have one, great stuff. But even then, be careful, because most of them aren't indexed. And what's more, it's a myth. It's a myth that most people spend much, much less in retirement than they did when they were working. They don't. They used to. I mean, people used to retire at 65 and die at 68. Okay, times have changed. People retire at 58, 60, 61, and living to be 90, 91, and 92. Many people in this audience will spend more years in retirement than they did working. Okay, times have changed. You can spend a lot of money. You're healthier, you want to do more. My dad spends a ton of money in retirement. It's very annoying. Very annoying, okay? All right. Number 6. My spouse is an only child and has rich, old parents. That's a good one. My only advice is there. Love that spouse. All right. Number 7, I don't understand financial planning. This is the one I get, especially when I go in and speak to young people. I tell them, you got to get involved in this stuff. I don't understand it. Well, take some time. Read a book. It's not that tough, okay? You can gain an understanding of it. It's not that deep. You're talking about something that could make the difference of tens of thousands, if not hundreds of thousands of dollars in the course of your life. No one else is going to do it for you. Take a little time, acquaint yourself with the basics. It's not that challenging. Now, those are the excuses you often see. None of them really holds water. And none of them is the real reason why most of us don't save for retirement. The real reason we don't save for retirement is right here. Is right here. We don't want to. Okay, we don't want to. We don't want to make even the small sacrifices that are necessary. We want to live life to its fullest. Again, keeping up to the Joneses is so important to most people. We love to buy stuff. We love to buy stuff on credit. I mentioned reading. You have to get the basic knowledge. We don't want to read a financial planning book. They're boring. All right, except mine. Right? Mine's a page turner, all right? But they're boring. I don't even like read them. I write them. Okay, they are boring. We don't want to read them. We don't want to make sacrifices. That's the real reason people don't save for retirement. It's that hurdle that an educator has to get past. How do you do it? Very simply. You try to teach people the most effective, in other words, the least painful way to save for retirement. You try to show them how to get to where they need to be without having a dramatic impact on their current standard of living. You try to teach them techniques that are fairly easy to implement, easy to maintain, easy to understand, because you need to have those 3 things if people will stick with the program. Now, for a vehicle to offer up all that, it would have to have 9 features. We're going to go through them quickly. If a vehicle is to be called the perfect retirement savings vehicle, it would have to have the following 9 features, and this is important stuff. First off, it would have to offer up a method of buying that involved forced saving. If you saw show number 1, you know I hate budgeting. Budgeting doesn't work. Okay, it looks good in books and it sounds great in theory, but in real life it's invariably sabotaged by human nature. I mean, who in here has budgeted successfully? Same person, all right? I mean, all right. Budgeting just doesn't work. The people who budget successfully are the same people who drink skim milk. All right? That's been proven. Okay, I mean, you don't want to party with them. What ends up, they end up in retirement with a whole bunch of money and no friends. All right? You don't want to go that route. Budgeting, again, is a myth. The way to save money has always been and will always be through forced saving. Pay yourself first. Take the money right off the top of the paycheck or directly out of the bank account. It works. You know, I would say of all the lines you hear in financial planning, the most important one is pay yourself first. You know, of all the thousands of people I've met who've come from modest income backgrounds and today are in very good financial position, that's been the common denominator. They take the money off the top of the paycheck or directly out of the bank account, and there's no way any vehicle can be called perfect if it doesn't offer an opportunity to employ that technique. Second thing you need to do and third thing you need to do are both related to taxes. You want to save with pre-tax dollars and you want to have tax-deferred growth. Now, pretty straightforward stuff. Why do you want to save with pre-tax dollars? Well, you've got more money working for you. Not only your money's in the program, but also the government's share of the money. And yes, you'll have to pay tax eventually, but in the meantime, it's all kicking in and compounding. Great stuff. The tax deferred growth, same thing. Every year as you grow, instead of the government taking its share, it's all staying in place, and the numbers can get mind-boggling. Again, we'll look at an example later that will literally blow you away. Now, these two are not without a potential drawback. Something you hear very little about, but you should pay some attention to, at least try to understand. This theoretically is a good thing, but it can potentially work against you. How? What happens if you're moving the money now from a relatively low tax bracket, let's say 15%, and taking it out late in life when you're then in a 40% bracket? Now people say, well, that can't happen. You always retire to a lower income bracket. Not always. Okay, a number of variables can change throughout the course of your life. You can move up the income ladder dramatically, you can inherit money, the government can just arbitrarily change tax rates in an effort to cure the deficit ills. All right, because of that, theoretically, these things could turn against you. Now, the odds are dramatically against that happening for a number of reasons. First off, governments now realize that you cannot indefinitely raise income tax rates and continue to raise tax revenues. At some point, you have diminishing returns. Secondly, you've also got all those years of tax-deferred growth working for you. And that can compensate for moving to a higher bracket. Now, I know this isn't fun stuff to listen to, but it is important. The bottom line on this is as follows. Although theoretically it can hurt you, you should still take advantage of it, because the odds are greatly stacked into those two things, not only helping you, but helping you dramatically. No one knows what the future holds. Play the odds. If you can save with pre-tax dollars and get tax-deferred growth, do it. Maybe 1 out of 100 of you will end up regretting it, but I would be surprised even at that. I mean, who really knows? It all comes down to a guessing game. Okay? Take advantage. Why? Well, because then benefit number 4 again is all the more powerful, compounding. I love this stuff. If I could die and come back as one thing, it'd be compounding. You know, I love compounding. All right, I love to look at the examples. I never get sick of them. In fact, in show number 1, we did 3 or 4. I'm only going to give you one today, but it is a neat one. Remember the king had the chess tournament? I got this a little bit off, but it's something along this line. The king had the chess tournament and all the peasants went in it. And a peasant won the tournament, and the king said, what do you want for your winnings? And the peasant very modestly and sheepishly said, take 1 kernel of wheat and place it on the first square of the chessboard, 2 in the second, 4 in the third, 8 in the fourth, and so on and so forth. Well, the king, not understanding the power of compound interest, said, sure, and that's nothing, go ahead and do it. What do you think it ended up being? 18.5 million trillion kernels of wheat. 18.5 million trillion. The king is in trouble. All right. What about the guy that had to count it? Okay, I mean, it's amazing what compounding can do. It is absolutely unbelievable. Now, a lot of people look at that example and go, yeah, 18.5 million trillion, it's so big, I can't even identify with it. Well, to put it in perspective for you, that's 16,000 million English muffins. Okay? It's a lot of English muffins. Now, as ridiculous as this story sounds, it's kind of playing itself out right now under a slightly altered form called the national debt. Compound interest can work against you just as well as it can work for you. And unfortunately, our government doesn't have the chance to deploy the same negotiation technique the king used. Okay? We gotta pay, and it can get a little ugly. Compound interest can be a dangerous thing, but for most of us, it can be a very powerful thing. The 5th thing you want, employer matching. I mentioned earlier that a lot of employers are passing the buck, if you'll pardon the pun, off to us and saying, hey, you've got to take on the responsibility. But several are also offering to match your contribution to some extent. Well, this is a bit of a straightforward proposition. They're giving you money. You don't turn that down. And for it to be perfect, of course, that has to be available. We'll look at that much more in depth a little later on. Number 6, you want a variety of available cost-efficient investments. Why? Because don't put all your eggs in one basket is good advice. All right? And although we've all heard it 100, 1,000 times, a lot of people pay no attention to it. Most people I meet and have a chance to examine their finances, all their money is in the same basket. You have to diversify. If you make one severe mistake when you're not well diversified, it can wreck your finances for years. You must spread the risk. And for a vehicle to be called perfect, it has to offer you that opportunity by having a variety of choices. If, for example, you're young and you want to invest in common stocks, which makes some sense. I mean, you've got 25, 30, 35 years, that better be available to you. If the retirement plan only offered a chance to buy CDs, very safe but low returning investments, not a very good situation. Conversely, and I've never seen this happen, but it's a good example, what happens if you're older and could only buy stocks? That too could be very, very dangerous. You want as many choices as possible, and what's more, for obvious reasons, you want those choices to be cost efficient. You want them to have no loads, if possible, no commissions in other words, and good expense ratios. You want as much of your money working for you as possible. I mean, that's straightforward, but it's something worth paying attention to. You don't want to get involved in programs where there's a lot of money leaving your pocket and going to middlemen. So that's an important thing to pay attention to. Number 7, you want dollar cost averaging available. Now, dollar cost averaging sounds confusing. Let's look at an example from show number 1. We'll go through it very quickly. Let's say you're saving $100 a month. You know, fairly reasonable sum, $100 a month. The first month, the mutual fund is trading at $10 per share. You're buying an equity fund in this particular case. That is a mutual fund that buys common stocks and therefore fluctuates in value. At $10 per share, you buy 10 shares, obviously. The next month, the mutual fund collapses. It falls 50% down to $5 a share. A disaster, but you persevere and buy 20 shares. The third month the 100 goes in, the mutual fund rebounds somewhat to 750, and invariably it would after that kind of monumental decline. You buy 13 1/3 shares. Now the average person says, this is not much fun, Dave. I started buying at 10, it's currently at 750, heck, it's been as low as 5. Look at the actual math. 43 1/3 shares you currently own, $750 per share, $325 in value, you've only invested $300. How does it happen? You're putting in a fixed amount of money each month. So when the mutual fund struggles and goes down, you buy more shares at lower prices, and that's key. Buy low, sell high, obviously pretty good advice. This forces that on you mathematically. What ends up happening is this. Your average cost per share ends up being lower than the average price per share. Mathematically, a pretty darn good thing over the long term. Psychologically, even better. When people buy monthly, they get much less stressed. And when the market corrects itself, and inevitably it does and falls whatever percent, instead of panicking like a lot of lump sum investors do, monthly purchasers tend to stick with the program, recognizing this might not be that bad a thing in the long term. Because while it's down there, you're still buying, and again, buying low. What's more, buying a lot low. Okay, so dollar cost averaging Buying mutual funds monthly with a fixed amount of money can be a very good move, both mathematically and psychologically. Now, very good and perfect, of course, are not synonymous. If the mutual fund goes to zero, you're in big trouble. But you'll own millions and millions of shares. Okay. Now, that's exciting, isn't it? Really. The eighth thing you want to pay attention to, and I know a lot of you are looking at this and saying, whoa, this doesn't make any sense, you want a penalty for early withdrawal. And this comes from the experience I've had in the industry. If you don't have something like that with any savings program, people won't be able to do it. What happens is, if they get past the first hurdle of not being able to save, the most difficult hurdle, the second one is, can you keep your hands off the money after the first few years? And most of us can't. You start seeing it grow, just hitting the bottom part of the compound interest curve, exactly when you shouldn't take it out, and we all get excited. Go on a trip, buy a bigger home, buy a car. You can't do that. And the only way to stop people from doing that, unfortunately, is with penalties. If you have a penalty there that stops people from doing it, great. So it sounds bad, but for most of us, it's very good. And finally, of course, you want generous allowable contributions. This other stuff's academic. If you only put in $200, $300, $400, $500 a year, you want to be able to put aside some good money. $2,000, $3,000, $4,000, $5,000, that's when it's all going to kick in. Now, if any plan could offer all 9 of those benefits, we'd be in pretty awesome shape. I mean, it would be the perfect vehicle. It would be easy to understand, easy to take care of, offering up a tremendous number of good things. Is there a plan that offers all that stuff? Well, we'll find out in Act 2. All right, stay tuned for Act 2. We'll see you after the break. Thanks a lot.
Stay with us for more of The Wealthy Barber coming up.
Well done. Well, we spoke about the perfect vehicle. I said there's 9 requirements, and they all have to be filled if a vehicle is to be perfect. Is there such a vehicle? No. Thanks for coming out. Yes, I'm kidding, of course there is, and it is called the 401k. The 401k is literally the perfect retirement savings vehicle when you go by those requirements. It is, though, one of the worst names I've ever heard for any product. 401k, how inviting. Okay, you're trying to take out the intimidation, take out the math sound. Somebody comes up with 401k. I think it's part of the tax legislation that originally developed the program, but a bad name. Now, I said this to several people in the industry. I said, that is brutal. And they said, well, that's why we call them salary reduction plans. Sign me up right away. No, really, I just feel I'm making too much money. You know, the bottom line is they should be called what they are, the ultimate retirement savings vehicle. These things are almost too good to be true. Let's go through point by point the 9 features from before, but apply them to the 401k. First thing we looked at, of course, is forced savings. It doesn't get any better than the 401k. It's right off the top of the paycheck. You don't have a chance to spend it. You can't spend what you can't see. My wife can, but the vast majority of people cannot. Okay? This stuff works. You ask the producer and the director right here in the show. They saw the first show, read The Wealthy Barber, went out, and they started contributing to their company savings plan. They came back to me this week and said, we don't miss the money at all. Now, admittedly, these are not sharp guys. All right? But still, that'll be edited out, I think we can safely assume. Okay? You can do it. Forced saving works, and it works very effectively, and nowhere does it work better than it comes right off the top of the paycheck. Numbers 2 and 3, here you go again. Perfect. Saving with pre-tax dollars, tax-deferred growth. They're both there in full force. The money comes off the paycheck before federal taxes. There's more money in there working. Get all the tax-deferred growth until withdrawal, which of course means compounding. Number 4 is even more effective. The kinds of numbers you can put up are startling. We're going to go through an example in a few minutes, a real-life example that was passed on to me in an airplane. There really is amazing stuff. It really is. Number 5, company matching, employer matching. Key. All right, that's what separates the 401k from most other, even most other solid vehicles, is in most cases, not all unfortunately, but most, the company matches your contribution to some extent. So for every dollar you put in, they may throw in 25 cents, 50 cents, another dollar, in some cases, not many, but $2. This is unbelievable. I mean, dollar for dollar, you can't turn that down. That's 100% return on investment the second you put the money in. I mean, you can't turn it down. Employer matching is too good to be true. You have to take advantage of it. And boy, can it ever be powerful again. Number 6, a variety of available cost-efficient investments. Again, in most cases, yes. Unfortunately, not all companies have gone that route. In fact, we'll talk more about that later on. But most do. And think about it. It's in their best interest to offer you as many good choices as possible. I mean, first off, they're contributing to the plan as well, they being the executives. It also fosters goodwill. Anytime you can put your employees on a good financial stance, everybody's going to benefit. So it's in their best interest to put together a very good package, offering a lot of different mutual funds with good expense ratios, good guaranteed products. You can really strike a balance, and that's what it's all about. And most companies do a very effective job in that regard. Next thing you want to make sure of course, dollar cost averaging. Again, the 401k, it's perfect. Right off the top of the paycheck, if you want to go the equity fund route, perfect. You've got the dollar cost averaging kicking in, and for you long-term patient investors, it really works out quite well. Number 8, penalty for early withdrawal. Again, that one sounds a little bit contradictory, but you do want it and you do have it. With the 401k, in the vast majority of the cases, when you take out the money before age 59 and a half, there's a 10% penalty tax plus income tax. Okay, both are payable. Income tax, of course, very fair. You haven't paid it yet, so I mean, can't complain about that. The penalty tax is a good thing. If you didn't have the penalty tax I mentioned earlier, you definitely would abuse it. You'd build a 401k up, you'd get your statement from your company, wow, let's buy a boat, the money's out and you're in trouble. Finally, generous allowable contributions, again, they're here. $9,000 or so is the index ceiling I'm approximating. Now, your own company will have its own rules and regulations, and there are some other things you have to be aware of, but in general, it's very generous. Several $1,000s, check with your personnel department, and it's very important that you get down to that personnel department immediately. All right, you look at a story we're about to talk about right now. I mean, this guy read a book, went to his personnel department, changed his life. All right, why? You've got tax deduction up front, compounding tax deferred growth, diversification, no hassle factor, a selection of cost-efficient mutual funds. I mean, it goes on and on and on. There are no negatives. Okay, there's no negatives with this. You have to take advantage of it. I talked about the example I wanted to give you. I was flying out to California a year ago. Sat beside a young man, a guy who said he had a tremendous amount of difficulty saving money. In fact, he turned to a financial planning book, and he loved the book and read through it and learned a lot. And one of the things it taught him was, if you feel saving is impossible, start out small. Why not try saving $5 a day? And he thought, you know, $5 a day sounds reasonable. But remember, $5 a day is actually a lot of money. That's $1,865 a year plus the interest. Now, $1,865 a year sounded daunting to him, if not impossible. But $5 a day, the same thing, phrased differently, sounded like something he could do. So he decided that's what he was going to do. Set aside $5 a day forever. Went to his wife, told her. She said, great, if you can do it, I can do it. They worked for the same firm. She said, hey, I'll have to sacrifice some lunches out, maybe smoke less, whatever, but between the two of us, we can save $10 a day. $10 a day, $300 a month. Good sum. All right, now, they also had read in the book that the 401k was the best route to go, and in their particular case, it sure was. They had the company matching. For every dollar they put in, the company put in 66.7 cents. In other words, when they put in $300 a month, $500 found its way into their 401k. At the end of year one, they had $6,200. Now, these are from people who couldn't save any money. At the end of year one, they had $6,200. That's a lot of money. I said to the guy, did you miss the money? Same answer as always. Didn't miss it at all. And what's more, he said that they also found psychologically they're in a much more comfortable situation, much less stressed, knowing their financial future was going to be taken care of. They're actually enjoying life more, despite the small sacrifice, than they had before. Second thing about this example is it doesn't even mention the tax rebate. Remember that $1,800 they're putting in each year comes off their taxes. They can get more money back to do whatever they want with. Pay off credit card debt, go for a trip, whatever. Look at the magic of the 401k. The $500 a month they're setting aside for 35 years. Why 35 years? Age 26 through to age 60. Savings are going to go up 4% a year. I don't mean that's the rate of return on investment, but they're going to raise the amount they're putting in by 4% a year, the inflation rate. So every year they're going to take their cost of living and put it in with the 401k. Makes sense, okay? We're not asking them to do anything out of the ordinary here. Just stick with the program and every year slightly increase your savings to match inflation. Rate of return, 9.5% per year. Again, very realistic. Equities have averaged over 10% over the last 50 years or so. So we're talking conservative projections here. This is a very realistic scenario with no additional saving, no outside planning at all, just the 401k. What do they have in retirement? $2.3 million inside the 401k. Now, when people first look at that, they always come back and say, yeah, but what's that going to be worth 35 years from now? $590,000 in today's dollars based on that same 4% inflation rate. That's a lot of money, okay, from doing one thing right. They save $5 a day and they're going to have $590,000. It's not fair. Okay? I mean, that's from $5 a day each. I mean, if you did more than that, obviously this gets out of hand, or if you had better rates of return or a longer time frame, or if you did outside savings. But we took a very conservative approach here. They only did one thing right, and it wasn't that big a thing. $590,000 in today's dollars. This is unbelievable stuff. I know this sounds dramatic and somewhat corny, but I said it earlier. The guy read one financial planning book, went to his personnel department. It's going to make the difference of millions of dollars in the course of his life. And you know what book he read? No. That's the really annoying part. It was Making the Most of Your Money by Jane Bryant Quinn. But I look at that and say, hey, the guy read the wrong book and he's still got millions. He reads my book, he's worth trillions. Okay, so I mean, you can see the point here. This is not that complicated. I mean, get down to your personality department though. I don't care how many times I say it, it's key. But if there's no 401k where I work, marry someone who does, all right, immediately. Now, if you can't do that, then there are other vehicles, and other vehicles can offer up a lot of good things. A couple of them I want to look at. 403b plans. 403b is a fairly well-known, again, not a great name. They're really very similar to a 401k. They're offered up usually by government institutions and nonprofit organizations. They're less likely to have matching. But that aside, they offer a lot of solid benefits, very similar to the 401k. Keogh plans, SEPs, are primarily for the self-employed. They're, again, a way to save with tax-deductible dollars in a tax-deferred manner. Sharp, very sharp, all right, in a tax-deferred manner. You also have IRAs available and tax-deferred annuities. Now, all of these products, admittedly, vary dramatically, and you have to do some research. There's no way around it. You've got to do a little reading, talk to a financial expert, but it's well worth your time. We can't get into all the ins and outs here. They're all somewhat similar, although tax-deferred annuities are a little different. There's no tax deduction up front. There's no company matching. They're the less good of all of them, really, to put it that way. You would never, for example, buy a tax-deferred annuity before maximizing your contribution to your available 401k. That would be very strange behavior. A lot of people do it, by the way, but it makes no financial sense whatsoever. So why do I say that? Because remember our parameter from earlier, and it will help you keep these things crystal clear when you read about them and talk to people about them. What you're looking for is the least painful way to save. That's always the thing to think of, the least painful route to a good retirement. When you remember that, it tends to make this stuff much more understandable. Now, a few tips before we close this off about investing the money. What do you actually do with the money when it's inside the program? Well, first off, just getting back to 401ks and 403bs for 1 second, set aside enough to qualify for 100% of the company match. Okay, you must do at least that. A lot of plans are set up along the following guidelines. You can set aside up to 6% of your income, but the company only matches the first 3% to the tune of $1 per dollar. Okay, well, at least do the 3%. Take advantage of the company matching. As I mentioned earlier, 100% return investment. You have to do it. Now, a lot of young people say, I can't afford to. Well, you can't afford not to. Okay, I mean, it doesn't get any better than this. You have to do that. So make sure you follow that guideline. Set aside enough to qualify. Start now. You're sick of hearing it, but again, it's a key point, and nowhere is it more so than within these tax-deferred vehicles. In general, I'm known as a very conservative guy when it comes to personal finances. Not because it's my nature, by the way, but because with personal finances, conservative is what works. But too many people are too conservative when investing their retirement proceeds. They tend to almost go exclusively towards CDs, GICs, those types of things. And I think those vehicles can play a very important role. But if you have the time frame, the relevant time frame, 10, 15, 20, 25, in some of your cases, 30 years, it really pays to be a little bit more aggressive and invest in some stocks, especially when you use dollar cost averaging into a well-selected mutual fund. Okay, it really, over the long term, makes a big, big difference. Now, nobody's suggesting wholeheartedly embracing risk and acting imprudently. I'm not saying get involved in options, commodities, etc. But a little risk can go a long way towards enhancing your return. And the key thing, again, I mentioned earlier, in terms of mitigating risk, is time. If you have time on your side, don't be afraid to be a little more aggressive. Peter Lynch, in his very fine new book, Beating the Street, has a very, very illustrative example. He points out that in 1926, if you took $100,000 and invested it in government of the United States long bonds, in 1989, you would have had $1.6 million. Not bad. If you'd taken the same $100,000 and invested in the Standard & Poor's 500, stocks in other words, you'd now have $25.5 million. You're talking big, big differences. Okay, now admittedly that's over a long time frame, but regardless, it's still a very important example. Don't get too caught up in being conservative. Use some diversification, use some common sense, but taking on a little risk is usually a good idea. Next one, push your employer for more alternatives. We spoke earlier, some companies haven't seen the light. For some reason, they haven't done an overly good job providing you with this opportunity. Get down and see them. Okay, I mean, they need to hear from you. It's not that deep. Get 4 or 5 people, get down to the personnel department and say, hey, we need more options. If I want to invest in stocks, aggressive stocks, or an index fund, whatever, I want those options available to me. Get down there and talk to them. They should be very open-minded. Again, it's in their best interest to provide you with the best possible program. Okay? Next one, be very careful about your own company's stock. Now this again is much more important when it applies to 401ks. A lot of 401ks allow you to invest in the company's stock. And although in some cases, of course, that's been a very good move, it's bad diversification and it puts you in a very precarious position, especially if you do it with 100% of your invested funds. And a lot of people do. I mean, you are really in the danger zone here. What if the company goes under? I mean, you're in big trouble. Can you imagine going home and saying to your spouse, hey, the company went bankrupt today, I've lost my job, and he or she says, well, don't worry, at least we've got that big 401k. That's another thing I want to talk to you about, honey. Yeah. That is not a good idea. And you know, I mean, I know I sound pretty conservative here, but even if it worked out okay, the stress would not be good over 20 years, worrying about your company running into a prolonged difficulty. Now, don't ignore the company stock, because it may be something, again, to look at for diversification reasons, but be careful about how much you get involved with. Think time and not timing. This sounds, again, a little bit trite, but it's important stuff. There are a tremendous number, especially in the United States, of self-proclaimed experts who tell you they can predict when to get in and out of stocks, into bonds, any money market funds. They look at these magical, mystical signals. They'll come back and say, when interest rates drop down to this level, switch over into stocks, then get back over here. There is no empirical evidence to support that these people can actually do what they're telling you they can do. Predicting markets is difficult, if not impossible in the short term. You've got to focus long term. Patience is your most important attribute. Dollar cost averaging is not fancy, but it's very effective. And flipping in and out of funds, trying to outguess the markets, for the most cases, proven to be a very, very bad thing to do. Involve your spouse in all financial decisions. You want to build some sort of synergy. There should be a common goal. You should be working toward the same objectives. And I'll tell you, even if you don't involve your spouse in the decision process, they still should be knowledgeable as to what's going on. I mean, these are going to be your biggest assets, these 401ks and 403bs. I believe both spouses should be involved in all financial planning, period. There are a lot of arguments back and forth about whether spouses should have separate accounts and you should handle things along that. I don't believe in that stuff. I really don't. I think you should just group the money together and you should go that route. I think in the long run, it'll work out best. But even if you disagree with me, and you're entitled to your own opinion, however wrong it may be, what you want to do is you still want to keep them informed. Now, what happens if, on the other hand, your marriage is in a tough position? Keep them in the dark about everything. All right? No, really. Does that not make perfect sense? Okay. All right, we'll be back in break number 3. I think you'll really enjoy the third part of the show. We're going to look at a lot of different things from a little bit of an unconventional stance. It'll be a lot of fun, so we'll see you after break number 2. Thanks a lot.
Stay with us for more of The Wealthy Barber coming up.
Okay, welcome back to segment 3. It's going to be a lot of fun. I have no idea what I'm going to say, and nor do you. We're ad-libbing a lot of this. I think it should be fun. We're going to go through a number of common sense pointers, but we're going to look at them from an unconventional stance. I think a lot of the wisdom you hear out there is not that wise, frankly. And I want to talk about a number of different things, but my favorite one we're going to lead off with is accidental death insurance. How many people here have this? How many people here have accidental death insurance? Put your hand if you have it. It's weird. No, it is weird stuff. Accidental death insurance is weird. I don't care what anybody tells me. It is the strangest product ever invented. It doesn't matter how you die. Okay, you have a definitive need for a certain amount of life insurance. Life insurance is great stuff. It's a great product. You can do all kinds of good things with it. Most importantly, if you die, you provide your dependents with a desired standard of living. I'm all for life insurance. Most of us need it. Most of us need a lot of it. But you don't need more if you die in an accident than if you die of any other means. I mean, you want somebody to be upset at your funeral. Okay? No, but you know what? I can just see my wife getting the call. Dave's dead. Oh no. How'd he die? Hang gliding. Yes. Okay? Like, really. Seriously. It is very strange stuff. I don't mind. In fact, I'm all for supporting the family when I'm gone. I don't want them to be pumped about it, though. You know what I mean? I don't want them to be all excited about the fact I'm gone. It's a weird thing to buy. You know, a very similar product is travel insurance. You know when you're going on a flight and you buy insurance that if you die in the plane, you get more money? Like, why would you do that? You don't need more money if you die in the plane. It doesn't make any sense. And you know what else about that has always bothered me? How do people know you bought it? You're dead. All right? You're trusting the insurance company to tell people. That's a questionable move, all right? No, that is a strange thing. And I know I'm getting a little off topic here, but you know something else that reminds me of? The strangest business I've ever seen. I've always wanted to know who runs this business. Are those change machines. You know the machines where you put a bill in and it gives you back change? But it gives you back the right amount. Like, where's the business sense there? Here's 5, you get back 5. Like, wouldn't it make sense if here's 5, you get back $4.95? Like, I don't understand how that guy makes money that runs those machines. I phoned that company. I said, how do you make money? The guy said, volume. Did anybody believe that? All right, second thing I want to look at, spreads. What is a spread? Well, every item in the world, every item that you want to buy has 2 prices. What you have to pay for it if you don't own it, and what you get for it if you try to sell it. Do you understand the difference? Wholesale, retail. Spreads are very important, and in investing, they're very, very important, especially in certain arenas. The best example probably being penny stocks. In penny stocks, the spreads are all over the place and they're huge and they can really have a negative impact on your potential for success. Let me give you an example. You phone up your broker and you say, I want to buy some XYZ, what's it trading at? He says 40 cents bid, 50 cents ask. What does that mean? It means that if you want to buy the stock right now, what do you have to pay for it? 50 cents. The least anybody is currently willing to accept that owns the stock. You change your mind a moment later, phone and say sell it, what do you get? 40 cents. The most anybody who currently wants to buy it is willing to pay. You've lost 10 cents or 20% of your money right away. In other words, phrased in different math, it has to go up 25% to get you back to even, from 40 cents to 50 cents. Not a good position to be in. Okay, very, very bad. And you throw commissions on top of that, and the math gets quite ugly quite quickly. Spreads can slant the odds way against you. You've got to be very careful. You know what they are. And most people have no idea what a spread is. You should always be asking about spreads. If, for example, you ever got involved in options, something I would advise you carefully consider not doing, spreads are big, and they have a bad impact. Same with commodities. You'll see big spreads in commodities, and they can really jump up and bite you. Now, I want to drive this point home finally with one quick example that is wrapped around a joke. The guy's out for a cab drive one day, and the cab driver says to him, I think you should get involved in a stock called Butterfly. It's going to take off, and this is big stuff. The guy says, great. Phones up his broker and says, what's it at? The broker says, 20 cents bid, 40 cents ask. He says, good. Buy 10,000 shares right away at the market. Buys the 10,000. Phones back the next day, what's it now? The broker says 60 cents. Unbelievable. I'm up 50%, he says. Buy 30,000 more shares. Next day it's at $1. Buys 40,000 more shares. And this guy is getting very excited. Phones in the next day, it's at $1.50. He says, unbelievable. Buy me 30,000 more. Well, it hits $1.80 the next day. He can't take it anymore. Phones his broker and says, sell it all. The broker says, to who? You're the only guy buying. Now, it is a cute story. When I first heard it, I laughed too. But you know what? It's not that far from being realistic. Remember, when that guy was buying, all he was doing was taking out the various asks. He's having no impact whatsoever on other people's bid. Not quite true, by the way, because oftentimes a rising stock gets more enthusiasm, the bid might move. But really, it's probably going to stay in and around the same level. That could actually happen quite easily. Spreads are an important concept, and more people should think about them when they invest in certain types of things. Next thing, avoid big losses. No, that's good solid advice, do you not think? All right. I don't care, again, how hard you laugh. Most people don't pay enough attention to this because they don't realize how mathematically significant it is to suffer a big setback. Let me show you something up here on the board. If you bought a $10 stock and it fell by 50%, and unfortunately with stocks that definitely can happen, you're down to a $5 stock. What has to happen for it to get back up to $10? Well, it has to rise more than 50% because if it does that, you're only back to $7.50. You're working from a new lower base. For it to get back up to the $10 after falling 50%, it would have to rise 100%. Okay, now I know this is simple math. You're saying, I don't need this guy telling me this. It is important stuff. It really is. When you suffer a big fall in any investment, you're in bigger trouble than you would realize because you're now working from that new lower base, and getting back to even is extremely difficult. It really is. And again, it points to the importance of diversification. Remember I said earlier, the arch enemy of compound interest is the wipeout? You can see why. I mean, what if you had all your eggs in one basket and went down 75%? You're now down to 25% of your original capital working for you. It's got to triple. Okay, you're actually asked quadruple to get you back to even, obviously. Tough. It's been my experience that the people who lose 50% are not the ones that are inclined to easily make 100. Okay, for obvious reasons, all right? Wills. Get one. All right, who in here doesn't have a will? A lot of you are liars. I know you don't. I spoke to a group of lawyers, by the way, recently, and I said, how many of you have wills? Fewer than half of them had wills. People don't think they're going to die. Okay, really. Most people don't think they're going to die, and they push this off. Don't make that mistake. We're all going to die, rest assured. Okay. I didn't mean that one, but it was actually pretty good. Write that down. Right, I'm going to use that again. All right, children's education. I'm very happy to say that when I travel across the country, the questions I'm asked most often from an audience are about how to save for kids' education. That speaks pretty highly of people when they put that as one of their big objectives. There are a lot of different methods. I mean, you can use trust, you can use mutual funds again, you can use baccalaureate bonds, you can use prepaid tuition plans in some places. There are a lot of neat things you can do. But by far the most effective way to save for a child's education, the least painful way, the way I emphasize with all the people I teach, is right here. Grandparents. Grandparents. Seriously. I have mastered this method. All right? They don't do it, you cut off visitation. Okay? I know it seems harsh, but you have to do what you have to do, okay? Most grandparents love to help out because remember, you're not asking them for much. You don't have to go to the grandparents and say, hey, we need thousands and thousands of dollars. Just get them to start when the baby's first born, hence the expression baby. Okay, $25 a month, $50 a month, that's all you need, and you'll have big money down the road. Most grandparents are eager to get involved. They really are. Now, if you don't have that available to you, and obviously not all of us do, there are all kinds of other good methods, but the key piece of advice with those, again, start when the child's young. Don't wait until they're 15, 17, 19, already attending school. Get it rolling at an early age. Now, a similar question I'm often asked is, how do you teach kids, whether it be young children or teenage kids, about financial planning? Well, don't give them books and don't sit them down and give them long lectures. It won't work. They don't want to learn about 401ks and life insurance and all that stuff. And most of the books out in the marketplace are not overly effective. They're well done, but they're not overly effective. You're not going to be able to get it through to them because they don't have any money. It's very difficult to get excited about what to do with money when you don't have any. Okay? The way you teach kids is this. You get them to save. You build the habit of saving for them, they'll take care of the knowledge down the road. People who save money effectively go out and get the knowledge. They have a vested interest. Okay, teach them to save 10% of all they make. That's all you have to do, and I guarantee you, your kids will be fairly financially well off down the road. Take 10% of their allowance, all gifts, any work money, invest it for long-term growth. Do it in an educational manner, whether you buy mutual funds or stocks that they might be interested in, anything you do, try to teach them at the same time, but most importantly, build the saving habit. $1 saved equals $2 earned. Again, a lot of this stuff sounds very simple, but people don't pay much attention to it. If you earn a $2 bonus at work, of that $2, you're going to usually lose $1. How? Income tax, Social Security tax, union dues, etc., leaving you with the same dollar you could have earned by comparison shopping, by using coupons, by exercising some thrift. Thrift is indeed a virtue. It's something we do very poorly for the most part. People are not effective shoppers. And by doing those types of things, that's where you free up $10, $25, $50, $100, $200, whatever. And it can make a huge difference down the road to your financial plan. I have a friend who went shopping for a car. Instead of just buying at the local dealership where I'm from, he went to all the small cities around, and in a few hours' work, located the exact same car he was going to buy in our hometown for $1,200 less within a couple hours' drive. $1,200. That's like earning $2,400 at work. Okay, that's a month's work. He did it in 2 or 3 hours. Most of us know that's possible, but still don't do it. It's weird how we're willing to work long weekends to make an extra $400 or $500, but people won't comparison shop. You have to do that kind of thing. It's by exercising that thrift again, you create the money you need to employ some of these other techniques. So I urge you to take a look at it. Andrew Tobias, a great writer, talks about a lot of complex things, but he also says, hey, if you see toothpaste on sale, buy it in bulk. I mean, you can be pretty sure you're going to be brushing your teeth for the rest of your life. If you're not sure about that, by the way, don't talk to me after the seminar. Okay? A little shaky on that. Refinancing debt. Now, I think you'll find this interesting because, again, we're going to look at this from a bit of an unconventional stance. The traditional advice is this. You'll always hear this from financial experts. If you have a lot of credit card debt, refinance it through a home equity loan, if you have that available, of course. And what they want you to do is drop the interest rate. Home equity loans charge a much lower interest rate than do credit cards, and also the home equity loan is tax deductible. The interest is tax deductible. So the effective rate is dramatically lower. Is it good advice? Debatable. Mathematically, very strong. The problem with it is what? The people who pay off the credit cards with the home equity loan run them back up again. What about the merits of paying off your mortgage early? You hear a lot about this. A lot of articles to read will say, look, if you paid off your mortgage early, $100 here, $200 there, whatever, look at all the money you'd save, all the interest charge you'd save over the year. Good point. No doubt about it. You're going to save a lot of money in interest. However, to be a truly helpful article, it has to compare that alternative to others. And the one mistake I see a lot of people hastening to pay off their mortgage when they really had better routes to go. For example, if you had a 401k available, it matched dollar for dollar, saving with pre-tax dollars, etc., but instead paid off the mortgage, not a very astute move. Okay, so you have to make sure it's not only a good move, but it's the best possible move for you to get involved with. I like paying off the mortgage. I mean, it reduces stress, it frees up cash flow, builds pride and ownership. Although the rate of return is fairly low, it's guaranteed, it's not going to kill you, but it's not the best thing you can do in most cases. There are other alternatives you should be looking at. Okay, final point about this one, this again is important, is a lot of people who hasten to pay off their mortgage do not derive the great financial benefit you would think once it's paid off, because when they finish, what do? They spend the excess money or buy a bigger home, which is what you're going to say. You see that all the time. They keep moving to a bigger and bigger home, but it never translates into financial wealth. All right, you've got to be careful you don't fall into that trap. You still have to build other assets. Recommended reading. I want to go through a few books here I think you should take a look at. There's some very good books out in the marketplace that can be extremely helpful to you achieving financial independence. The New Century Family Money book by Jonathan Pondell. The book's very new. Came out in the last 6 months. Extremely well done. I think you'll really enjoy it. It's more of a reference tool. I mean, it's 750 pages. You're not going to sit down and read it all in one shot unless you're very weird. But it's very good. It covers off a lot of points very well. And I'll tell you the thing about Jonathan Pond that is just very good. He knows a lot about a lot of things, but everything he talks about, he always brings back to this. Spend less than you make. And that's still 90% of the financial planning game. That is 90% of financial planning is Spend Less Than You Make, and he is very good at talking about living within your means. Second book I very much enjoy, Making the Most of Your Money by Jane Bryant Quinn, Simon & Schuster. I mentioned this book earlier. It literally turns somebody's life around. It's a good book. She's very adept at doing comparisons. Remember I talked about comparing the mortgage pay down to other alternatives? She does a very good job of structuring her book along those lines. Big book, again, it's a reference tool, 900 pages. You're not going to read through it in one sitting, but you can use it for a number of years. Very helpful. She also writes for Newsweek and has a syndicated column, and it's very well done. You can always benefit from reading her. The third book, Anything by Andrew Tobias. I mentioned him earlier, very funny and very poignant, good stuff. Keeps it basic, keeps it humorous, very gifted writer. He really started me. I mean, I read his books 10, 12 years ago, got interested in all this stuff and got involved myself, and really everything that's happened to me I kind of owe to him, but I'll give him nothing, all right? Nothing. All right, the next book is kind of the classic, the one you want to take a look at. The only thing I would say, it's kind of awkward saying something about your own book. Not that I can't do it, but it's awkward. The only thing I would say with this book is, a lot of times with this one, you're a little better to buy it in multiple copies. All right, this stuff's not that complicated. You read a couple of those books and you'll be astonished at how quickly all this stuff seems to fall into place. It is not that bad. It really isn't. Get at it. Reading is key. Education is key, as with anything. Now, when I'm asked, how do you become wealthy? How do you do all this stuff? Hey, it does not come down to learning the intricacies of the stock market, limited partnerships, and all that stuff. It comes down to honing the qualities of thrift and patience until they become habits. That's what personal finance is all about. You make thrift and patience into a habit, you'll be very wealthy down the road. Very wealthy. Thanks a lot. You've been a very good audience.